Welcome. Today we're exploring a key concept in investing, the bull market. If you've ever heard the term and wondered what it really means, this video is for you. If you find this content interesting, don't forget to comment and like. Let's continue. The term comes from the way a bull attacks by thrusting its horns upward. Bull markets can last for months or even years. What matters most is sustained growth, not just a temporary spike. Several factors can fuel a bull market. Strong economic indicators, low interest rates, and positive investor sentiment all play a role. During bull markets, investors tend to buy more stocks, expecting prices to continue rising. It's a time of optimism, but also a time to stay grounded. Even in a bull market, not every stock performs well. Overconfidence can lead to poor decisions, especially if driven by hype rather than research. The opposite of a bull market is a bear market, when prices fall and investors become pessimistic. Understanding both helps you navigate market cycles more effectively. Some of the most notable bull markets in U.S. history occurred in the 1980s, 1990s, and after 2009. Each period brought unique opportunities and lessons for investors. To invest wisely during a bull market, diversify your portfolio, stay informed, and avoid chasing trends. Patience and strategy are your best tools. Bull markets can be exciting, but smart investing is what truly makes the difference. If you found this video helpful, give it a thumbs up, subscribe to the channel, and leave a comment below.